Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Anantha Nageswaran, part-time member at PMEAC, who will be talking to us in his personal capacity with all his views as well. Welcome to the show, Anant, and always a pleasure to speak to you.
Thank you.
Anant, my first question coming to you is, from March last year to now, the first 2 quarters, when COVID started, were a complete wash off. We started to see a recovery that started to come in from the third quarter onwards. However, you have the second wave, which has started to come in, and that's derailing to some extent. And the sequential momentum is slowly, going on. I mean, it's slowing down from here on. What are your thoughts on the same?
So, thank you for mentioning that I'm speaking in my personal capacity, which is obviously the case. I'm not representing either the Government of India or the Economic Advisory Council. So, I think the situation is quite fluid at the moment. We are waiting to see if the impact of the second wave is restricted to the first quarter of the current fiscal year, or if there will be a spillover into the second quarter and so on. A lot depends on how confident the households are, because this time, obviously, as we all know very well, the impact has been felt by people across all income classes, and therefore the key to recovery will be how quickly households consumer spending can recover. So I would say that definitely, compared to the estimates we had at the beginning of the year 2021, when there was a lot of talk of India growing at somewhere between 11 and 12% in constant prices and close to 17% in nominal terms, that seems to be not that doesn't seem to be likely.
Right. So with all of this, clearly, if you go to see earlier, the case was that rural was pretty strong, and that's where we were taking support from.
Yeah.
In the second wave, Anand, what's happened is it started to spread in rural parts of India as well.
Yeah.
Do you think rural activity will continue to remain resilient, or do you think our piggybacking on the rural economy is not really going to help this time?
No, I mean, obviously, this is also a very, very difficult question to answer. But I would, if I may hazard a guess, I still think the rural economy would hold up better than we fear. I think they are, simply because I believe behaviorally, I think they are made of more sturdy stuff than we, the urbanites, who consume too much of unnecessary information and worry ourselves to death. I think they keep their lives relatively simpler. And given the predictions of a normal monsoon, and the fact that they are hardy and resilient, I would still expect, and I think the government's food procurement last year was very good. And this year too, I think they will go all out to make sure that the procurement happens in a very big way, if necessary. So I have a feeling that rural economy would still turn out to be one of the brighter spots when we look back from the towards the end of this year. When we look back, we would have felt that the rural economy again came to the rescue.
Right. So if you have to compare rural growth in FY22 to FY21, do you think it'll be better, or do you think it might be slightly slow?
It might be slightly slow, but not very much so. Yeah, I think to better FY21, I think we have to see a very, very strong growth and a very sharp tapering off of the impact of the second wave in rural India. So that it's possible, but I wouldn't necessarily consider that plausible. But I would still think that compared to the expectations we have right now, rural economy would hold up quite well. But whether it does as well as it did in FY21, that might be a tough ask.
Right. And with this, if you talk about the FY22 budget as well, the government had actually cut their allocation to the rural sector, including for the Manrek scheme as well. With what's happening right now, do you think a need for a revision is warranted and the allocation again needs to be hiked?
Look, I mean, I think the government last year too took the approach of providing fiscal relief to the economy as and when the need is felt quite explicitly.
Hmm.
So, in a way, we should in fact look back and say that had the government exhausted all its fiscal bullets last year itself, we wouldn't be able to even talk about the possibility of another fiscal stimulus in the current financial year.
Hmm.
And we should also remember that now everybody who missed out calling the second wave, and I don't blame them for that, it was definitely both in terms of speed and scale. It was quite unexpected. Are now, in order to be cautious or predicting the third wave, so then the government might be called upon to support the economy even further. And I hope it doesn't happen, the third wave doesn't happen. But if it does, the government would again be required to step in. So therefore, the government has a fairly unenviable task here. So if they don't try to be preemptive, I can understand that. So they have, for example, yesterday there have been some announcements of supporting orphan children and the extension of the emergency credit line guarantee scheme to other sectors as well. And in that ECLGS scheme, we still have roughly 50,000 crores that are not yet utilized. So the government, and I think the Honorable Finance Minister also gave a very comprehensive interview to the Times of India group. And she clearly said that she is open to providing necessary support. And I think they are going to play it in a gradual, calibrated manner. And I can't really fault them for that.
Hmm. Hmm. Right. So, Anant, with all of this, now RBI has forecasted a 10.5% growth in FY22. Do you think India will be able to easily achieve double-digit growth?
So, as I mentioned earlier in my remarks, I think
Hmm.
the double-digit growth number at the moment looks like it is an optimistic one. But that said, again, if you have to cast our own mind back to last year, I think on balance, we would have been in March, April, May 2020, we would have been happy with the 7.5% real GDP contraction, which is what I think we are going to end up with for the financial year 2021. So in that sense, at the moment, it looks like somewhere around 9% seems more realistic. But that said, if the last 2 quarters of the year turn out to be quite resilient and strong, we will be able to cross the double-digit mark. But right now, I would put my number closer to the 9% mark than to 10 and above.
Right. So that's with regards to where GDP goes. Simultaneously, if you see in terms of where inflation is concerned, a lot of debates in between, Anantha, that we heard that probably the government needs to ignore inflation at the moment. But with the new regime, do you think there is a higher risk that inflation could get unanchored?
Obviously, all of these are highly probabilistic
Correct.
statements, and I personally think I don't think inflation will get out of control. Partly because we are in a relatively low demand situation, consumer sentiment is hurt, and there is fear. And even e-commerce websites, despite people staying at home and lockdowns and ordering things, I hear from some brokerage reports that even e-commerce related transactions have slowed down, have declined so far. So I think in this situation of low demand, notwithstanding the higher price for fuel products, etc., I still don't think inflation would get out of control. It may stay closer towards the upper end of the RBI's band of between 2 and 6%. It may stay closer towards 6. But even if it is 10 or 20 basis points on either side of 6% or whatever, I think the central bank would probably look through it, and that would be the right thing to do.
Mm-hmm. And with this, again, on the global front as well, there is a raging debate on whether the current price pressures are temporary or
Yeah.
permanent. And yes, there are a lot of many moving parts here. You have
Mhm.
global commodity prices that have risen by an average of almost 80% since
That's
the
right.
trough of April 2020. Corporate margins have been hurt. There has been a spillover into consumer prices. Now, taking all of this into consideration, do you think we may not witness a new super cycle from here on?
Oh, again, just to mention to you, over the weekend, I had a chat with my friend in New York, was been living there for more than 2 decades or three,
Mm.
as to whether this whole inflation outlook in the United States is going to be transitory or something more than that. So we both felt, and I think it might turn out to be a little more than transitory, but that's exactly what even perhaps the Federal Reserve may want, because the unstated policy here, and that's of course a personal view, is that the Federal Reserve may be trying to reduce the real value of the debt that has accumulated over the last 12, 13 years. So would it lead to a very hasty normalization of the Fed monetary policy sometime soon, or even in 2022? That I still think is a slightly lower probability even. So whether India would be overtaken by global events, whether there will be a commodity super cycle leading to a permanently entrenched inflation, I still think as long as labor costs remain subdued, the transformation of the current commodity price spikes into a generalized and persistent inflation, I still think it is not yet my baseline scenario. Yeah.
Right. So, Anant, with this, how do you think we will see an impact coming in for the Indian market? Because we're talking of inflation where US is to some extent saying that it's going to be transitionary. In India, there has been a delay with regards to vaccination as well. There's tapering by the US Fed, and you have commodity prices touching the roof. So, how do you think India should perceive all of this? And how will it impact inflation and the RBI's stance on the same, according to you?
So I think, we had discussed the inflation angle and how RBI will respond. As I said, they may look through it. But if you're talking about the financial markets, was that your question? I mean, so
correct. Overall, yeah.
So I think the difference in the financial markets between the United States and India is, while on the one hand, I can understand the Indian government's calibrated fiscal responses to the evolving COVID scenario, the fact is that the United States had gone all out in the course of 2020, and even now the current president has submitted a $6 trillion budget proposal to the Congress. So if you look at it, the United States has gone all out to provide support to households and businesses, which means the public sector has taken on a lot of debt in order to transfer cash flow and wealth and income to households and businesses. So to that extent, it supports private demand, and therefore, purely from a valuation standpoint, the S&P 500 index, even though I am no fan of the equity markets at current levels globally anywhere, I still think the egregious overvaluation is probably more so in the Indian context than in the US context, simply because the public sector has taken on the burden of supporting growth over there, right or wrong. Whereas in India's case, given our starting points are very different, our credit rating is very different, and our own fiscal situation is very different, the government has taken a calibrated approach. And that means the private sector isn't as well off as the United States private sector is. And to that extent, I'm not sure that the current valuations are that adequately supported by expected earnings in 2021 or 22 in India, as it appears to be in the case of the US. It's a different matter altogether, that the overall sentiment in the United States is still extremely exuberant, and it is evident in the kind of assets that are going up in value, which have no earnings whatsoever. So that there is an unsustainable euphoria in the United States is unarguable in my view, but may not be that much evident in the stock market valuation per se, but in the overall environment. I think the Indian context is, I think the market valuation is slightly more elevated given the earnings outlook for the current financial year than it is in the case of the United States.
Right. So with all of this, you have the RBI meet that is scheduled between the 2nd and the 4th of June. And this will be the first bi-monthly policy review for fiscal 22. Do you think they will continue to maintain their accommodative stance? Rates will continue to be on hold right now?
I think so. I think that seems to be at least as we speak, that seems to be a relatively easier decision to make. I think for now, there is enough justification for them not to rock the boat in terms of monetary policy and continue to stay in a growth-friendly stance, both in terms of monetary policy and other liquidity and regulatory policies. It will be. I expect it to be more growth-friendly rather than focusing on inflation at this point.
Right. And with this, by when do you think will the RBI start lowering surplus liquidity, raising the reverse repo rate, and change its stance to neutral? Because the anticipation is that at least, say by October, December 2021, at least major of the masses or the critical masses are vaccinated. Do you think that's the time where we could see all these things happening?
So again, I think as we said about many other questions that you asked, there is a view, but it comes with a huge band of uncertainty. I mean, we must acknowledge that in the current context, we have to make up things as we go along, remain flexible. So I would say that's a question, even the contemplation of the question of withdrawal of accommodation or the beginning of a return to normalcy, in my view, that is more of a second half question to be even considered, let alone answered. Because even if vaccination, and I think we do understand that the vaccines would start to become relatively more freely available from this month, from June itself. And by the time we come to the end of the calendar year, India might well have progressed sufficiently with respect to vaccinating a good proportion of its population. And whether that automatically facilitates the resumption of economic activity would also depend on if there is a third wave, and if so, how muted or how strong or virulent it is. And also, more importantly, what happens to asset markets in the developed world? Because if the asset markets had by then begun to correct there, it will definitely cast its shadow in developing economies, including in India. Because when asset markets go down, the correlation actually goes up between markets. So I think it is not just purely a question of responding to the resumption of normal economic activity. That's one consideration. The other consideration is also what happens to global asset markets and the global growth outlook for 2022. So I think it would be safe to say the question of whether monetary policy and liquidity policies, etc., can be withdrawn and RBI can return to a more normal stance. At this moment, I do feel that the question feels like a slightly remote one.
And with all of this, Anand, if you talk about the balance sheet, we've seen a modest expansion that has come through.
That's
now,
right.
Do you think this would lead to lower provisioning and higher surplus in 2021?
You mean for the commercial banks?
Yes.
Yeah, I think again, we need to see the delayed impact of last year's growth contraction and last year's economic contraction and this year's lower than originally expected growth. What kind of spillover effect? But I think it's good that the large companies appear to have weathered their situation very well. And this year in the lockdowns, manufacturing activity hasn't really been suspended as it was last year. So again, I would think on balance, my initial response or a default response would be to think that the commercial banking sector should survive with minor scratches rather than bad bruises.
And then what's the kind of impact are we expected to see on the asset quality? Because April, the credit growth has been slightly higher as compared to what we saw in March. Deposits have slowed down slightly. And clearly, the credit to deposit ratio has moderated to almost 71.8%. What would this actually mean? And how do you think we should be viewing this kind of data at this point in time?
So, I think the credit growth in general being on the weaker side, excepting as you pointed out in the case of April. It's not just a supply issue, it's also a demand issue. When capacity utilization as per the RBI's OBICUS survey, hovering around 70%, clearly there is less of an appetite to borrow and invest. So that's also MSMEs being rather slightly more impacted by the COVID pandemic than the larger companies. both their demand for funds as well as loans to them are on the weaker side. So I think given the fact that the credit activity itself has been muted, I find it difficult to envisage that India would be overwhelmed or overrun by credit quality issues. So I still think whatever outcome that we experience with respect to credit quality, I'm not saying that there will not be a deterioration. It is inevitable given the economic slowdown we have experienced, but I still think it would be a manageable one. But we
Right,
speak with a wide band of uncertainty as we discussed earlier.
right. So I was reading Anantha CMI report which said that 11 lakh jobs have gone amid the rise in COVID.
Yeah, yeah.
Now, do you think this will hit the economy and the earnings of India Inc. and will put banking and financial sector, including NBFCs, at a risk in the near term?
So, I mean, look, most of the CMIE employment projections and data are based on surveys. And here, we also had, and I very much like the fact that my friend, the chief economist of SBI, Dr. Soumyakanti Ghosh, and his academic also partner from IIM Bangalore, Dr. Pulab Ghosh, they had come up with this idea of estimating India's formal job creation through data from the EPF registrations and enrollments, net of withdrawals, and also looking at enrollment in the National Pension Scheme, NPS. So based on that, if you look at both EPF, net new registrations or conversion from informal to formality, both in 2019-20 and 2020-21, India appears to have created close to 1 crore of jobs. And that is roughly about 1 million per month. Of course, they concede, Soumya concedes in his report that it is mostly low income jobs. But that said, it is still in the formal sector. So contrary to some of the dire statements we get about the state of the labor market based on CMIE surveys, what we see from this is that the economy has been able to create jobs, maybe not to the extent of, not to the extent we like, and not with the kind of incomes that we would like to see. But it isn't an extremely bleak scenario. So again, from that point of view, I do see some redeeming features of the situation, of the labor market situation here.
Right. And Anand, with all of this, now if you have to take the earnings outlook for FY22, taking the unemployment, which could be on a rise, do you think the government will have to come out with measures to support the MSMEs, to support people below poverty line due to the partial lockdowns that we've seen in different states, the slowdown? And with all of this, do you think we will be able to achieve the fiscal deficit that has been laid out in the budget and the action by the global rating agencies?
Your question has multiple layers. I think let me start with the point that will the government be required to support MSMEs, low-income segments, etc. Again, we should, if you cast your mind back to the second quarter of last year, April, June, that is when India had just begun its lockdown in March, and then it was continuing. There was this lot of calls for massive fiscal support to the economy, etc. And the government wasn't on the face of it responding with very liberal support to the economy. But I think as we came towards the end of the year, December 2020 and January 2021, it became clear that the government's approach was the right thing. It did not waste too many of its fiscal bullets. So similarly, once again, now there is a call. Of course, they say this time it's a bit different because even the urban consuming class has been affected. So it's possible that the government may be required to come up with a bigger support for MSMEs and the low income segments this time around more than it did last year. We have to wait and see. But the government has already stepped in with the extension of the ECLGS scheme for more sectors. Including hospital sector, and also including for purchase of installation of oxygen plants, etc., and so on. So there is a response, and the food subsidy has been extended. So I have a feeling that the government's response will once again be calibrated. And as for the budget is concerned, I think one of the things that was very good about this budget, and one of the most important and welcome departures from past practice, has been the emphasis on realism of its assumptions with respect to revenues. And therefore, there is wiggle room within the budget numbers to expand the fiscal stimulus without breaching the deficit and debt ratios that the government has in mind. In other words, even if the privatization, disinvestment receipts are not exactly to the extent that the budget had envisaged, there is still room for the government to be able to undertake fiscal stimulus and without sacrificing fiscal prudence as envisaged when the budget was formulated. I think there is scope for it.
Right. So do you think, but there will be a breach on the fiscal deficit front? Because clearly, if you look at the borrowings, we are just reading reports, $22 billion more is what India is looking to borrow to compensate the states for a tax shortfall. How do you think this will impact? And secondly, with regards to where, if you talk about FY22 as well, the government is targeting somewhere between 6.8% of the GDP. Will that overshoot as well?
No, I really think it's very, very early days to be able to speak about these numbers in a very meaningful manner at all, because we don't even have the full numbers for the year ending March 21. I mean, the March numbers are still missing. And I have a feeling that the government of India will be starting off the financial year 21-22 on a much better footing than has been envisaged. So in that sense, there is a bit of a cushion that's available to the government. And as I said, whether the government ends up breaching the 6.8% target or is able to stay within that and provide the necessary support to the economy will depend a lot on how well the vaccination proceeds and how well the opening up happens, etc. So right now, I would say it is very premature to prophesy that the government would inevitably or unavoidably breach the fiscal deficit target of 6.8% for the current financial year. I think that it's really very early days to make that kind of forecast.
Absolutely. And I think overall as well, with all of this, another aspect that everyone's watching out for is, how the movement in the bond yields is expected to pan out, because everyone is expecting that yields would go up due to higher borrowing programs of the central and the state government because of the rise that we've seen in global yields and the expectation of higher CPI inflation in the coming months. But that does not seem to be really the case. So how are you expecting bond yields from here on and the impact on the rupee lastly?
So on balance, we have to say that the risk of bond yields being higher than where we are now, around 6% for the 10-year. I think the risk of the yields being higher exceeds the risk of the yield going lower. So in other words, if you put a gun to my head and say you have to take a view on where the bond yields will be by the end of the financial year, I would say they would be either where we are or slightly higher rather than lower. On the rupee itself, my current view is honestly, even people, when some of my friends ask me for their own personal planning purposes, I'm telling them that this time I don't have a very strong view that the rupee is going to trend towards one particular direction. I'm not so concerned yet about the risk of the US monetary policy normalization, and normally that could mean the dollar strengthens and the rupee weakens, etc. I'm not there yet, even though that could be the view of many international brokerages and economists. I'm not convinced yet. So I think I would honestly say, with respect to your rupee dollar view, you can just simply take a coin from your wallet and just spin it and decide whichever way, heads or tail. Whatever forecast that comes to your head, you can take it. I feel right now it's going to be more or less stable around the current ranges, current values. Yeah.
Right. All right, Anand. Thank you so much for speaking to us, and always a candid conversation is welcome from you. Thank you. Stay safe and speak to you soon again.
You too. You're most welcome. Thank you.